So let's check this topic. This topic, IS number 19, employee benefits. So that doesn't make it work. The objective is where necessary, you say things. The objective of IS 19 is to prescribe the accounting and the disclosure for employee benefits, requiring an entity to recognize a liability where an employee has provided services, and to recognize what? An expense where the entity has consumes economic benefits of employee services. So, you know, which one? NSSF. We contribute, they also contribute. So the employer contributes, you also contribute. So they need to recognize an expense in relation to that and also a liability to that effect. So examples of employee benefits, one. An expense when the entity consumes economic benefits. Yes. Examples of employee benefits, we have salaries and wages, post-employment, medical, life insurance benefits. We have jubilee benefits and termination benefits. Jubilee benefits are which benefits? Huh? It's November 50. Yes. When an employee turns 50. Whichever. Profit sharing and bonuses. The above categories may be classified into two. They can be classified into short-term employee benefits and post-employment benefits. So short-term are those benefits which are expected to be settled before 12 months after the end of the annual reporting period, during which employee services were rendered, but do not include the termination benefits. These are your salaries and the rest. Post-employment benefits, these are benefits attributable to an employee upon retirement. The entity may have formal or informal post-employment plan for its employees. The accounting treatment for post-employment benefit plans depends on the economic substance of the plan during the period, under which consideration will be based on the class of post-employment benefit plans as either defined contribution plan or a defined benefit plan. A defined contribution plan, this one's me, I'm not going to go to read all of them. Where would I sum? Defined contribution plan is where the amount you are contributing to the scheme is known. What you will get will depend on the performance of the scheme. NSSF is a very good example of defined contribution. Niliona mkiulizwa 2019 to differentiate between the two. Defined benefits, the amount you are contributing, where unaweza plan, unaweza jipanga, it's not that fixed, but what you will receive is what you determine in advance. So now we contribute to, at the end of year 10, provided you have contributed what we have agreed, we'll be able to give you a sum of this and that and that. Note, when accounting for a defined benefit plan, down there, various actuarial assumptions must be taken into consideration. The actuarial assumptions are classified into two. So I hope we know the actuaries. Actuaries are the people who normally fix how much you are supposed to contribute and how much you will receive. They do it having taken into account so many issues, so many, the age, the economic and everything. So the assumptions they make, we have what is called final assumption, and we have what is called demographic assumptions. Where some are those ones you will read. Then we have accounting. I want it down there for the accounting for defined benefit plans. So IS 19 requires that an entity should recognize both plan assets and plan liabilities in relation to a defined benefit, not bandit. Defined benefit plan. If the plan assets, so plan assets is what you have saved in the scheme. What you have saved, whatever you have saved in the scheme is your plan assets. Whatever obligation you have in the scheme, because sometimes you have not contributed, that is called plan liability. Scheme is what we'll be calling the plan. It can also be called fund. Fund, scheme, plan, one and the same. So if the plan asset exceeds the plan liabilities, that means you have contributed more than what they wanted you to maybe to settle, then the entity should recognize a surplus and a plan asset in the financial statements. Similarly, the entity needs to recognize the following components. So we have what is called service cost component, interest cost component, and we have what is called remeasurement components. So during the year, an entity needs to check in the scheme and bring into consideration those three components. I don't know whether they were the ones which were being asked. Hebu fungua karatasi yenu 2020 kidogo tu, then we come back. May 2021, not even 2020, 2021. Online, are you comfortable with me sharing on the screen, or you are comfortable from reading it from the fonts? I decided to share. Okay. 2021, May 2021, someone to read for me very fast, question 5C. The
objective of international IFSAS 39 is to prescribe the accounting treatment and disclosure for employee benefits in public sector entities. Required with regard to IFSAS 39 employee benefits, describe the elements of the measurement component of the net defined benefit liability asset and indicate how the treatment of the remeasurement component under IFSAS 39 compares with that of commercial sector entities under IAS 19 employee benefits.
Oh, okay. So we are going to answer it down there. So they were asking the elements of remeasurement component. So the elements of remeasurement component. So the components which we do have are three. The elements are three. We have the service cost component. So when you will be doing those workings, you need to capture all those components: the service cost component, the interest component, and remeasurement component. But in that question, I thought they were asking those elements, those components, but they were asking you the elements of remeasurement component. So it means you need to know what is the remeasurement component and what it entails. So let's check them one by one. So service cost component, this includes the current service cost and past service costs, together with any gain or losses on settlement or curtailment. Curtailment is just the reduction. Current service cost is the increase in the present value of the defined benefit liability resulting from employee services in the current period. So when the liability goes up as a result of the services they are providing, that increase in the obligation, that is called the current service cost. Past service cost is the change in the present value of the defined benefit obligation for employee services in the prior periods. Curtailment occurs where there is a significant reduction in the number of employees covered by the plan. Settlement occurs where an entity enters into an agreement to eliminate the obligation by paying the retirement benefit. So service cost component, you check. These people gave us services during this year. Is there an increase in the obligation which we are supposed to pay? Like right now, there is rumor. I don't know whether it's rumor, sorry, it's true. That in SSF, we are going to, they want us to make some adjustments. It's true, eh? Yes. So when we make the adjustment will affect the employee and the employer. So if there is that increase in the value of obligation, then those ones are termed as current service cost component. But if we are backdating, like you are much aware, there is a pending court case. I think it was taken there in 2017. Are you aware? NSSF. The 6%, see, kuna hii mambo ya tier 1, tier 2. And old rates. And whichever rate you use, there hakuna mtu amewahi kusumbua. Yes, tier 1 and tier 2 was taken to court. Yeah, I think in 2017, where they wanted the employer to contribute 6% of your gross, and you also contribute 6%. So, in case that case is determined that it should be effective, and though what we know, the law is not applied retrospectively. No, it's applied at the cost progressively, yes. So if it's to be backdated, now you have to adjust, then those are called prior, the past service costs, if you have to incur for what was provided in the prior periods. So service cost component majorly is the current service cost for what was provided this year. You have to incur in relation to that. Past service cost for whatever was incurred in the previous years, but you need to adjust in the current period. We have interest cost component. This relates to the charge, not the charge, the change in measurement of both plan obligation and plan assets arising from the passage of time. It is computed by applying the discount rate for the plan obligation and expected rate of return on plan assets at the beginning of the financial year. The interest cost component is expense to the employer, where the expected rate of return is recognized as an income. So interest rate component, unajua ukisave na scheme, hata NSSF is not constant. That you contribute 200, unakuwa 200 kweli, 1080. Whatever you are contributing, ati utahesabu hiyo mpaka ukiretire unasema I also have my computation. Bring yours, we compare. No, it fluctuates, and the fluctuation can go up to favor you, or it can even do what? Go down. Like the people who are being paid in the current economy, I don't think if they will get much because the performance is low. So whatever you are saving, the interest you get on it, that is called return on assets. While whatever they charge you, because if you don't contribute to the scheme, also there are some which you are supposed to be charged. That is now the interest cost component. So the interest charge will be based on the obligations, while return on assets will be based on what you have saved in the scheme. Then we have remeasurement component. This comprises the actuarial gains or actuarial losses arising during the financial period. So the actuary, you know, actually they normally do projections in advance. They project that in the scheme, you will be able to have maybe 1 million at the end of year 2022. Then the actual outcome differs. Maybe in the scheme, you find that you have 1.1. So that one, we call it actuarial gain. So remeasurement component, you need to check the scheme. What was the plan? What was the projected value vis-a-vis the actual outcome? So you find that the actual outcome may be low or higher than what was being anticipated. So if it is higher, we recognize in the books what is called actuarial gain. If it falls below the anticipated value, then we talk of actuarial loss. So actuarial loss or gains on the increase or decrease in the pension assets or liabilities that arises due to changes in actuarial assumption or due to differences between the previous actuarial assumptions and the actual outcomes in the scheme. Here the story. Actuarial gains or losses should be recognized in other comprehensive, please note that with a lot of concern, in other comprehensive income during the financial period. They should not be recognized in the income statement. So they should not go to P&L. We bring them as other comprehensive income. Then there is this question which you had read for us, the May 2021, question 5C. They were requesting for the elements of remeasurement component. So remeasurement hiyo kuangalia scheme tena, how is the performance going? The actuary anticipated this, what is the actual outcome? So the elements of remeasurement components are the actuarial gains and actuarial losses, return on plan assets, then any changes that affect the plan assets excluding interest components. So accounting treatment under IPSAS 39. So for private entities, we use IAS number 19. For public sectors, we apply IAS 39, IPSAS 39. So for the government, according to IPSAS 39, IPSAS 39, the remeasurement, the remeasurement component, those are gains and losses, should be recognized to equity and should not be classified to surplus or deficit in the subsequent periods. So we take them as part of the financing activities, if it's for the government part. But for IAS 19 in private sectors, the remeasurement component, that is gains and losses, should be recognized through other comprehensive income during the financial year under consideration. So for private sectors, if we gain, we lose, we take it to other comprehensive during the year. But for the public sector entities, we take it to accumulated. You know, government does not talk much of equity, rather accumulated funds. So we take it to accumulated fund account. Note, defined benefit plans should always be measured at their fair value, while benefit liabilities should be measured at their present what? Value. Liabilities measured at present value, while assets are measured at fair value. So what is going to be our main concern here? How to determine the actuarial gains and actuarial losses. Let's not waste my time. Wewe ukitaka kusoma hiyo kitu, somanga. Read it. They can ask you anything. Otherwise, get out your past papers. Get out your past papers. How are your relatives at home talking about me? What are they saying? Kwani wewe waje Thomas?
This time you are serious.
Oh, wewe ni umekuwa serious? Oh. Scholar anasema you don't respect Sundays. We do. But now life. Start with which question? Hii shida yote ni nyinyi, hata si you are the problem. Why do you want to do exam in 3 months? Kwa nini msifanye within 6? Hapana, si customer walisema we plan yourself.
School teaching 6 months.
Well, Thomas, the buta futa is one. Six months ni kidogo. When last semester wakuleta kitu kwa employee benefits? Nimejaribu kupitisha macho sioni. I've tried to pass my eyes. How? Basi kuna siku tumeiona hapa. Hawa. Hawa. Yesterday we saw it together with others. Hiyo ya 2014 hiyo ya April ni kidogo. Wacha tuanze na kubwa ndio tukuja kwa hiyo msikie vizuri. Wacha tuanze na kitu serious huku mbele. Go to December 2017. Yeah, that one is nice. December 2017. What wa page wako? December 2017 is which page? Question 2C. Adam, question 3B, which one? What to come here? Page 85. Tupatane. Sawa, tutarudi hapo. Page 85. Let's meet in page 85. Page 85. Page 85. Yes. There. Question 2C. So let's kick off with this one. So this is December 2017. Thomas, what is motivating you? So we read, the following information was extracted from the books of Comfort Retirement Benefit Scheme. Wanakupea jina mzuri hata wakikuja uweke pesa unaweka tu, sio? Comfort Retirement Benefit Scheme. Moja hiyo siku darekali unajua si Comfort. Unatembea huko. Unafika wanakuambia uko na pesa hapa. Retirement ya ngapi? Imefika kitu 900,000. So kindly, we need to start the process. So number one, enda utulete tax compliance KRA ndio tuanze process. KRA ukifika, we came to our realization in the year 2009 that you had rental properties and you are not filing tax. The record held in this office shows that you owe KRA 1.5 million. So you are required to clear 1.5 so that you process 900. So 2016, 2017. So discount rates. So discount rate is the interest rate for determining when you delay liabilities, they charge you on that. Then expected rate of return. So expected rate of return is interest income on what you have saved. Average remaining service life, no problem. Fair value of plan assets. Then we have present value of plan obligation, current service cost, benefits paid, contributions to the scheme, past service costs. Additional information number one, as at 1st November 2015, the present value of the plan obligation and the fair value of the plan assets were both 100 million. So 2015 is the opening towards 2016. Assume all transactions occurred at the year end. Required for each of the years ended 31st October 2016 and 2017, determine the actuarial gains or losses. 2, the net pension costs to be charged to the income statement for each of the 2 years. And 3, balances to be reflected in the statement of financial position. So when they talk of the actuarial gains and losses, you assess 2 items. On the asset is now your savings to the scheme and also the obligation. You know, even bank, if you save, so kuna na some charges. So zingine inachajiwa mpaka inakuwa negative, sio? Yes. So you check your obligation in the scheme. If you have not settled, you charge interest on that. So there is always that projection. If you don't pay, this is what you will be charged. Then you compare with the actual outcome. You check whether you have gained or you have lost. Then on your contribution, also you try to make adjustment. You check whether you have gained or you have lost. So when you are asked of the actuarial gains and losses, you try to check your plan assets vis-a-vis your plan obligations. So let's start with which one do you want? We start with plan assets or plan obligations? Tuanze na obligations. Baada ya hiki tuanze na obligations. So actuarial, right there, actuarial gain, stroke loss on plan obligations. Tuliona mtu akiuliza baada ya dhiki ni faraja. Ndio mtu akiuliza ni dhiki ngapi kwanza? Ndio dhiki mzee amemoja ifiki. So they want that one, you will compute for those 2 years. You will compute for those 2 years. So 2016, 2017. 2016, but you can start with the end. Thomas, andika. Kwa ile cha hapo watu iko kama bado tafuliwa in anticipation. So obligation is measured in present value. Always liabilities, because they are future, they're paid in future. So you say present value of plan, but it is resulted to the same. Ukishaelewa hizo zingine itakuwa tu walkover kwetu. Present value of plan obligation brought down. So brought down in 2016, brought down 2016 is the one which was in 2015. So 2015, they communicated something in note 1. All of them were, both asset and obligation stood at how much? 100. So have you 100? Then you top up. There is always that clause. If you have an outstanding obligation, you will be charged interest. So interest is the one they are calling discount rates. So you add to that obligation interest charge. So interest charge 2016 was 10%. So you take 10% of the opening. Opening is 100, so that one will be 10. Then go down there. Go down there. We have fair value present current service cost. Current service cost is also an obligation. So you add current service cost. It is a charge which increases the liability. So current service cost here is how much? 8. Benefits paid. So benefits paid, please listen to this. When you pay benefits, we will reduce the planned assets as well as planned obligation, because obligation is assumed to be assessed on whatever you have in the scheme. So when you are paid obligation, when you are paid benefits, reduce the obligation and also reduce the assets. You credit the investment account and you debit the obligation account at the same time. So benefits paid will affect both. So when you are paid benefits, the assessment will go down proportionately. So benefits paid, you are paid how much? 15. So what you get, if you don't have projections, is called actuarial assumption. Actuarial assumption. They tell you Whatever is accurate here, ni ile yake. Then they tell you during this year, if you don't pay, you will be charged 10% on this. Then you will have to incur current service costs for this year of this. Then you will be paid benefits for this much. So all these ones are projections, just assumption being made by actuary, which is how much? 103. Then you say there, actuarial gain or actuarial loss. So we'll record a gain or a loss depending on the actual outcome. So present value of plan obligation carried down. Can you check 2016? How much was the closing value of the plan obligation? There is past service cost. Someone is telling me, oh, there is past service cost. I have not seen it. Thank you. If there is past service cost, you charge it in the present year. Sorry for that. So we fixed it somewhere. Past service costs. You charge it in the current year. You don't backdate the books. So past service cost was how much? 4. Yeah, just top up. So instead of 103, we talk of 107. Thank you. How much is the actual outcome in 2016? Which you can see. Yeah. 2016, when we are closing in November, how much is the present value of plan obligation? Huh? 100. Are you seeing the 100? Yes. So in November, the actual outcome in the scheme is 100. So the actuarial assumption, what was being anticipated, is that we will have an obligation, a closing obligation of 107. The actual outcome is 100. You have gained, you have lost. How much? We will lost, huh? Yes. Is again, eh? Si ukiambiwa mnaenda kulipa exam custom, kuenda kulipa exam ni obligation. Eh? Then umeambiwa unaenda kulipa 107. Kufika kwa counter unaambiwa hapana, it is 100. You have lost. You have gained. So we have gained how much? We have gained 7. So the gain should reduce the obligation. Nice again. Then the closing in 2016 becomes the opening in 2017. So take it there. In 2017, interest charge. So this one was 10%, comma. This 2017, they are charging what rate? 8. So 8% of 100. How much is that? 8. Current service cost? 120. 10. There was no past service cost in 2017, but benefits paid 12. Give me the adjusted, the actuarial assumption. Actuarial assumption is what the actuary was anticipating in the scheme. What the actuary was anticipating in the scheme, 106. 106. Then what is the actual outcome in the scheme? The actual outcome, 125. We have gained, we have lost. We have seriously lost. How much? The obligation has gone up. 20? 19 today. Yes. We have lost 19. So that is gone. We have determined the gain or loss on that. Let's go to plan assets. I don't know why those people are later you to 2 marks. Because this one is 1 mark. But the work is right, so I don't know. Actuarial gain stroke loss on plan what? Plan assets. on plan assets. So plan asset, the same way, the arrangement 2016, 2017. So present fair value, plan assets, we talk of fair value. Fair value of plan assets brought down. Fair value of the plan assets brought down was how much? Zote zilikuwa 100 in note 1. Both plan asset and obligation were 100. Then there will be expected rate of return. So expected return should be annual. So based on the opening, 12% and 10%. So 12% of the opening gives us 12. So our contribution, our savings will be adjusted with interest of 12. Then there is contributions to the scheme. So contribution will increase. So contribution will increase our asset base. Contribution was how much? 9. When you are paid benefits, you reduce benefits paid. How much? 15. Therefore, what remains in the scheme is the actuarial assumption. So actuarial assumption is how much? Actuarial assumption there. 106. The balancing figure will be actuarial gain or actuarial loss. Actuarial gain or actuarial loss. So you compare with the actual outcome in the scheme. So the actual outcome, you say fair value of plan assets carried down. What was the closing plan assets? 96. Sure. So we have gained, we have lost. We have gained, we have lost. We have gained, we have lost. So we have lost. This is an asset. Obligation. They expected an asset of 106, only for the value of the assets to go down to 96. So we have lost. We have lost how much? 10. So this one becomes the opening next year. So this is 96. Charge 10%, 9.6. Contributions to the scheme, 11. Benefits paid, 12. How much? $104.6. Actual outcome, 110. We have lost, we have gained. We have gained. How much? 5.4. So I want us to get the net actuarial gain stroke loss. Have that. So the net on the liabilities, you know, like the same year in 2016, on the assets we lost, on the obligations we gained. So you need to compress the two. So on plan obligations, then on plan assets. So on plan obligations, 2016 we did what? We gained. So then on the asset side, we lost. So the net position remains a loss. A loss of how much? 3. On obligations, we gained 7. On assets, we lost 10. So net is a loss of 3. In 2017, on obligations, we lost. We lost how much? 19. On the assets, we gained 5.4. So the net position is a loss of how much? 13.6, which is a loss. So that is the net. I don't know why the marks allocated were not equivalent, but it's how it was given on a pen. That's how it works. That was Roman 1. So Roman 2 of the question, I hope you are done. Roman 2, they want the net pension cost to be charged in the income statement. So I hope everyone is done with this. So write down there, net pension cost to P&L. Net pension cost to P&L. Net pension cost to P&L. There. So net pension cost to P&L. You start, so we have 2016, 2017. So you bring here what? Current service cost. You just pick those things which you see to be expenses in nature. So current service cost, that is one expense. How much? 8 and it is 8 and 10. Yes. Then benefit is not an expense. Contributions, no. Past, yes. So past service cost, it is also charged this year. Past service cost. Past service cost is 4. You charge it in the current year, though it relates to prior years. Then there was interest. Interest expense. So interest expense, they have deleted for plan obligations. Interest charge. 10 and 8. So those are the expenses which we can be able to pick up. So can you add this? This is 18. This one is 1422. Less return, expected return, expected return. Expected return is an income. So we have these expenses to charge P&L, but expected return is an income. So reduce, offset the Sunelo. So expected return is 12. The other side, 9.6. So these ones are income, while these ones are expenses. So to get the net expense, reduce. Yes. So reduce those expenses using the available income. So net pension cost will be 8.4 of that. Hata ungefunga. Andika hapa OCI, other comprehensive income. Other comprehensive, hapo chini. Other comprehensive income, net actuarial gain, stop loss. Net actuarial gain, stop loss. So the net actuarial gain, stop loss will go to other comprehensive. This one goes to P&L, but actuarial does not go to profit account. They go to other. So pale, sile tumefanya hapo. We got actuarial loss in each case. So do we appreciate these are also expenses? So you add them because they are also losses. So we had actuarial loss of 3. Here we had actuarial loss of 13.6. But if they were actuarial gains, then I will use those gains to reduce the costs. Do we agree the 10 and 8.4 are costs? Yes, and these are losses. So adding a loss to cost is the same thing. So get those figures, 13, and this is 20. We go through my 3 of the question. Hassan, what is the issue? Hassan told us in the morning that in 2027 is going to vie for governorship in Nairobi. How many people are going to support him? Mheshimiwa, the ground is with you. No, wanatoa Sunday classes. So, Roman 3 of the question, balances to be reflected in the statement of financial position. So balances to the statement of financial position. (16) 17. So what goes to the balance sheet? Here inanga maneno. Give me the present value of plan obligation carried down and the fair value of plan assets also carried down. Carried down. The closing. You go for the closing. Balance sheet, we check the closing. So closing, you can even pick it from the question or from where you are, where you did your whatever. Plan obligations, are you seeing 125? Yes. 100 and 125. The closing in November for each year. Then assets, 96. And the other one, 110. So if you check keenly, you're straight. Obligations are more in each year. Sure. 196, 125, 110. So obligations are more. So if obligations are more, then we utilize the assets to reduce the obligations. So subtract the assets to reduce the obligation. So you remain with the net pension liability. Net pension liability of how much? 4, where? 4. And this one is? 15. The question is over. The question is over. May 2019. May 2019. May 2019. Question 3. There is something I want in that question. May 2019, question 3, that is November. Which page? Thomas bado ako kwa. Usikii kila kitu yeye anafikiria loss. Thomas, God works in different ways. Don't worry. You never know. However, tell Guardiola to scale up. May 2019, question 3B. Which page? Mine is 61. Page 61. Hizi ni tukipata kwa mtihani unanao nayo uso. Simuenda Christmas. Custom sio lazima watakuwapea Christmas gift. Na gift yao inakuanga kwa swali. Lazima wanaleta swali nyepesi. Ubaya watu wana concentrate intergroup sales. Soma hizi pia rahisi. Wanaleta swali rahisi kabisa. Watch a group. Usually. You wish, and wale wengine wakienda ndio dangerous. Ama hujui. Wale ndio watu wanaanguka. These small topics are part of even those huge ones. It is May 2019, question 3B. Out of the 3B, going 3A. So we read, it says, with reference to International Accounting Standard Science number 19, employee benefit, briefly explain the accounting treatment of the defined pension surplus, that is plan asset, in the financial statement of an employer. Tukaandika. But hakuna kitu hata kuandika hapo. Utasikia. W Limited, a public limited company, operates a defined. Hata kutaja kujisumbua niliweke kwa hiyo theory handout. Anyway, surplus in the books of employer is recognized as what? As a plan asset during the financial year under consideration. However, you have to take into consideration the plan liabilities. But iko hapo, niliwawekea kwa hiyo handout. Wewe soma kabisa hiyo handout, those solutions. W, a public limited company, operates a defined benefits pension plan for its employees. The present value of the future benefit obligations on 1st January 2018 was 3080 million, and the fair value of the plan assets as at the same date was 2860. Further information relating to the pension plan for the year ended 31st December 2018 were as follows: current service cost, benefits paid to former employees, contributions to the plan, present value of plan obligations, fair value of the plan assets. Additional information: interest cost Gross yield on blue chip corporate bonds is at 5%. Ni kujifanya tu. Hiyo ni rate of interest. So if they give you one rate, that is one of the reasons I'm doing the question. If you have one rate, then the rate cuts across both on the return and the expense. And that's how it should be. But in most cases, for obligation, rate iko juu, for return, the rate iko chini. So if it cuts across, the better. So you get one rate in exam, then apply it both on plan assets and plan obligations. On 1st January, the pension plan was amended to provide enhanced benefits with effect from that date. The present value of the enhanced benefits on 1st January 2018 was calculated by actuaries at shillings how much? 110. So there's an adjustment we need to make for a value of 110. Required. The required notes to the statement of comprehensive income and statement of financial position to reflect the financial effects of the defined benefit plan. 8 marks. So those things they are calling notes is workings. So you need to know the procedure. Check what? Gain or loss on plan obligation, gain or loss on plan assets, get for us the net, tell us the pension costs and the pension liabilities or assets. Those are the notes. So just do those workings, then you will be safe. So start there with actuarial gain, stock loss on plan obligation. Please, there is no restriction. You can start with plan asset. But me, I feel if you have asset and obligation, it's good to start with obligation. Hata nyinyi mkiwa kama mtu anakula, ukienda kula, sasa mkitoka hapa unaenda kula lunch. Then asa lunch upate umewekewa lunch. Hata kuniliona kuna mtu wengine kama kuna kuku na ugali, anamaliza ugali kwanza. Sio?
Ugali na sukuma.
Anabeba ugali na sukuma. Then ukifikiria ameshiba, you anaanza. So it's good to start with obligation. So we start here. It is 1 year off. This is 2018. So shillings are in millions. So obligations is the present value of plan obligation brought down. How much was the plan obligation at the start? Where the question started. It's 3080. The present value, yes, 3080. However, fair value is always for the assets. 3080, but check note number 2. I want to add that enhancement. Enhancement of how much? 110. So the question is, why am I adding it to obligations and not to the assets? What is making me to adjust it to the liabilities? The present value. If they could have said fair value, you adjust it to the assets. So 3080 plus 110, 3190. So enhancement is just amendment and increase, which is supposed to be there. Then you top up the interest. The interest charge 5%. One? 159.5. You top up. Then current service cost. Current service cost. How much is this? 209. The benefits they have paid. Where is it unafanya zinamakiwa? Benefits paid They are the notes. 242. So the actuarial assumption, why do we call it actuarial assumption? Umeiona nani akisema hapa insurance. Si wakuja anakuambia if you do this, you will be able to get this and that. Sio? Ruth ama hujai kwa approach. Na anakuwa msichana, sio? Na kuna specs. So how much is this? 33? 16.5. So that is what the actuary anticipates in the scheme. Skip one line. I don't want to declare actuarial gain or loss. It's just one line. So just skip for me a line. Ama uandike tu actuarial, lakini usiseme gain ama loss. We are coming. Balance carried down, or we just say present value of plan obligations carried down. How much? 33.60. I hope you are seeing 33.60. So we have gained, we have lost from your assessment. Be serious. We have lost. So the obligation has gone up. The assumption is that now for 20 I don't know. Why did we add 110? Sharon nakaambiana. Read note number 2. Mohamed pia akajibu, so fine. So we have lost, we have gained. So we got to plan nini?
Our obligation. Supposed to be that
16. Even unasema ndio mzuri. We had planned an obligation to be 16. Then the actual outcome is that in the scheme the obligation is we have lost. The obligation has gone up. So that is actuarial words. Loss, balancing figure. We have lost how much? 43.5. Okay. These are the relevant notes. Then actuarial gain stroke loss on plan assets after hii mtihani watu wata relax. Least mtu yote ako na harusi atuandike kwa group. We just want to walk over this holiday. We walk everywhere. You let us know in advance. We just want where we can walk to release the stress. So you can declare early. So fair value of plan assets brought down at the beginning of the year. No. So the first paragraph up there, 28.60. Then expected returns. The rate was 1. The rate was uniform, 5%. So 5% of 28.60. 143. Then contributions. Contributions to the scheme will increase your asset base. How much? 259. Then you less benefits. Benefits paid. Benefits paid is how much? 242. So the actuarial assumption actuarial assumption. Actuarial assumption is how much? Okay. 30-20. So the balancing figure is actuarial, we don't know. So fair value of plan assets carried down. How much? But 13. So actuarial gain loss. Yes, what we can do. That's again because this is on asset. So we have planned our savings will be 30-20. Now we get a value to 31. So this is actuarial gain of how much? 93. So down there, you say net actuarial gain on the assets. On the assets, we have gained how much? On the assets, we have gained 93. On obligations, we lost. We lost how much? 43.5. Therefore, the net gain will be how much? Yeah, 49.5. Also, let me not say it's a requirement, but I think I'm going to common sense. I don't know. The rate was 1. They were giving us a 5%. We were also being charged 5%. So the interest charge, they were to charge us how much? 159.5. And also we were to receive on the same rate, we were to receive how much? 143. So net interest, itabaki net interest income ama net interest expense. Expense. So the expense is 159. Now income is 143. So net interest expense, it will remain an expense, will be 159.5, and we are receiving 140 what? 43. So we are remaining with net interest expense of how much? Yeah? 16.5. So let's get for them what will go to P&L. What goes to P&L? Then we tell them the balance sheet items. Then we are done. So right there, pension costs. Pension costs. Pension costs. Yes, no, net pension costs. Net pension costs. Net pension costs. So net pension costs bring current service costs. Current service costs. Current service cost is how much? 209. Then interest. Interest will be a net. So net interest expense. Interest expense. Interest expense, we have quoted 16.5. Yes, there is nothing. So can you add? Those are the expenses. Those two. That one comes to 2.5. OCI, other comprehensive income. We got net actuarial. Net actuarial what? Gain. So remember 225.5 is cost. But we have a net actuarial gain of how much? 49.5. So utilize the gain to reduce the costs. So we are remaining with a total expense. 176. So that is the net pension cost. I hope you understand why we are subtracting the actual gain, because 225 is an expense. This is an income, so utilize income to offset that. All right, then let's check the balances to reflect in the balance sheet. So balances to SFP, balances to the statement of financial position. So right there, fair value of plan asset carried down. Fair value of planned assets carried down. Carried down plan asset is how much? 31, whatever. Present value of planned obligation. How much? 33.60. Which one do we subtract to reduce which one? But you can subtract any, by the way, there's no issue. But me, I would prefer the obligation is more. So I utilize this one here to get net pension liability. But you can subtract with that other one, then you leave it as negative. There's no problem. How much?
247.
247. But if you subtract this one, you just have negative, then there is no problem. There's no problem at all. All right, let's go to, that was which one? May 2019. Let's go to 2022. Ama tuanze na 2020 kwanza. Let's go to 2020 first. November 2020, question 5B. November 2020, question 5B. November 2020, question 5B. November 2020, question 5B. Sasa hiyo inapatikana wapi? Wait. 47, 48, there about 49. Page 49. Page 49. Yes. Yes, iko huko. Page 49. Please go through it as I wrap this. Next one is mostly in November. B. What are they saying? On 1st January 2019, Kamili Limited commenced a defined benefit pension plan for its employees. Under the pension plan, Kamili Limited has an obligation to provide staff with agreed post-employment benefit plans. Camille Limited carries the actuarial and investment risk associated with the pension scheme. The following information has been compiled for financial year ended 31st December 2019. Interest income on plan asset, 16,500. They have already calculated. Employer contribution given. Current service cost there. Interest on plan liability given. Fair value of plan asset there. Present value of obligation there. Camille Limited accountant was not sure which accounting standard to apply. So which accounting standard was supposed to apply? IAS 19. When accounting for pension scheme, the only adjustment made to account for the scheme was to expense the company's contribution of 55 for the financial year ended that in the statement of profit or loss and other comprehensive income, and to credit the cash account. So yeah, bother hizo mambo ya actuarial gain, sijui service cost and all that. Hiyo pesa walilipa, credit cash book na kaweka kama expense. Full stop. Na kaenda lunch, akasema I'm the accountant of Camille Limited. Required, evaluate the treatment of Camille Limited's accountant and evaluate the treatment Camille Limited's accountant has given the above issues and offer any correction if and where necessary. Hapo ifai kuwa na full stop, inafai kuwa hivi, if and where necessary, use journal entries. Hapo unasema hili tofauti na kitu tulikuwa tunafunzwa. So evaluate how she has treated that information. So you have to talk fast. Yes. Yes, you have to write what kama hiyo kitu alifanya iko in order, then do for us what was supposed to be done. So let's have a solution there. You say, unaanza anzia mbali. Si kwanza ajui standard yenye inatumika. So unaweza anza kumwambia hiyo. Unamwambia the standard to be used is this and that. So let's write and say the applicable standard for employee benefits for private commercial entities is IAS 19. Is IAS 19. Full stop. Another paragraph. Camille Limited pension plan. Camille Limited pension plan is a defined benefit plan. Is a defined benefit plan. Is a defined benefit plan. Since the company has an obligation. Since the company has an obligation to provide post-employment benefits, has an obligation to provide post-employment benefits. Full stop. Another paragraph. The accountant has accounted for the employer's contribution. The accountant has accounted for the employer's contribution to the scheme incorrectly. Contribution to the scheme incorrectly. The accountant has accounted for the employer's contribution to the scheme incorrectly by simply recognizing the contribution, in the statement of financial position, by simply recognizing the contribution in the statement of financial position, in bracket cash book, and as an expense in the profit stock loss account. In the profit stock loss account. Full stop. Another paragraph. IAS 19 requires that a defined benefit liability. IAS 19 requires that a defined benefit liability should be recognized. A defined benefit liability should be recognized in the statement of financial position, less the fair value of plan assets at the end of the reporting period. At the end of the reporting, less the fair value of the plan assets at the end of the reporting period. Full stop. Another item or a paragraph. The accountant has also ignored the current service costs. The accountant has also ignored the current service costs and interest charge. The current service costs and the interest charge in the P&L. In the P&L. The P&L. Another item. In addition, I'm not going to similarly. In addition, the accountant should have recognized actuarial gain, stock loss. In addition, the accountant should have recognized actuarial gain, stock loss in other comprehensive income. In addition, the accountant should have recognized actuarial gain, stock loss in other comprehensive income. Full stop. Therefore, the accounting treatment should have been as follows. The accounting treatment should have been as follows. So what we do, if and where necessary, use journals. Si ati ni fan, lazima utapitisha journals. Si ati kama hakuna wacha hapana. Wakisema inakuwa. So what we do let's get those gains, those losses, then we show them. What were we supposed to recognize in P&L? The current service cost, the interest, then in other comprehensive, we were supposed to check the actuarial gain, actuarial what? Loss. So instead, when they talk of journals, instead of you coming up with the scheme balances to P&L and balance sheet, show us how they are supposed to be recognized in P&L and how they should be recognized in the balance sheet. So let's start. Actuarial gain, stock loss on plan obligation. So let's do the workings first so that we get those things she did not capture. You know, with her, Ali debit, alifanya nini? Hawajasema ha? Wameandika nini? Si shika somebody shift wa hii. Wameandika nini? Wajasema? Na kwa nini nimeshinda nikisema ha? And because wamefanya mistake. Now instead of checking the actual gains, losses, current service cost, ali credit cash book. Ile pesa ilipwa ile contribution, ali credit cash book na ga expense that amount. Then story ended there. So in pension, get the actuarial gains, losses, recognize the current service cost, the interest and all that. So let's start with actuarial gain, stock loss. on plan obligation. By the way, I don't know what happened last semester. Share-based and employee benefits. Zote mbili ifai kukosa. Ifai, nimeona hii kukua. Very dangerous. So expect both of them or one. Unaona gani? Both. The bet. Kukosa inakuwa ngumu, those two. So prepare for one or all. Equal all the sawa. Equal all share-based part A 10 marks. Employee benefits part B 10 marks. Alafu si unapata zote. Alright. So there we go. Shillings are in what? So this is obligation, present value. So present value of plan obligation brought down. It was how much? Hata ikukwa, we are not given. It's not there, it's not there. Then we are given interest. Interest on plan liabilities. Plan liability interest was how much? 18,000. That's how I want to charge you interest on what? Then current service cost. Current service cost. 600. 600. Benefits paid. Was there benefits paid? Right? Hakuna kitu kama hiyo. Therefore, actuarial assumption is how much? 600 and what? 18. So we have actuarial, I don't know. So present value, present value carried down. How much? It is 620. 620. So this is actuarial gain loss. Loss. The obligation has gone up. So actuarial loss of how much? 2. That is a loss. Let's do the same. Let us do the same. I hope you are done with that space. We do the same for plan. Let's do the same for plan assets. Let's do the same for plan assets. Chop, chop. So right there, actuarial gain loss on plan assets. They can arrest you. You joke. All right. So we go for actuarial gain stop loss on plan assets. So on plan assets, fair value of plan assets. There is nothing like that. But there was interest income on plan assets. So interest income. 16,500. Contributions. Contributions was how much? Contributions 500 50. Benefits paid. Hakuna. Therefore, actuarial assumption, how much? Actuarial assumption? 5? 566. Actuarial gain loss. You don't know. Fair value carried down. Is that 580? Actuarial what? No, you don't actuarial gain. Because the asset was anticipated at 566, it has gone to 580. So actuarial gain of how much? 13,500. So net actuarial gain. Net actuarial gain. We have gained 13,500, and the other side we lost how much? 2,000. So we are talking of again of 11,500. Have that. Sasa nikikuja utaacha ati hii ni kali. Also interest, you can compress for me interest. Interest expense was 18 on the obligations. This side interest 16. The net position will be expense income. Well, expense, no. So net interest expense, we had an expense of 18, but we had an income on interest of how much? 16,500. So we are talking of net interest of 1,500. Good. Then maliza hiyo. So wanasema where necessary use journals. So instead of coming up with the extract of P&L and balance sheet, now give them journals. So what I want to take to the journals, I will take actuarial gain, I will take the interest, and the other thing you need to capture in the journals is this one, current service costs, those expenses, because the interest tumeshareka huko. So now what do we take to P&L? We take interest, service costs, and the actuarial gains. So interest we have already compressed. Gain we have, so current service costs. So those three. So write that there, journal entries. Journal entries. Journal entries. Journal entries. So journal entries, BR, CR. Share-based employee benefits ikosa kwa mtihani inakuanga bahati mbaya. The two should not miss. Ukiangalia hiyo trend yote, the two doesn't miss, at least one, but sometimes both. So let's start with actuarial gain. So actuarial gain will reduce the liability. So what actuarial gain? Yes, the gain will reduce our liability. So a reduction in liability, you debit the liability account. Then you credit, so inakuwa hivi. Debit pension liability. Then you credit other what? Comprehensive income. Because pension liability, when you have an income, it will reduce the liability. A reduction in liability is a debit. Because the liability account is credited. So if you reduce the liability, you debit the account. And the income, the gain will reduce the liability. So 11.5. To recognize actuarial what? Gain. To recognize the actuarial gain. Recognize the actuarial gain. Number 2, let's bring interest expense. Interest expense will increase the obligation. So, yes, coming acquire interest income, you reduce. So interest expense will increase the obligation. So you debit P&L with interest. Interest is debited, then you credit pension liability. The pension, the net interest will increase. That is 15. That is 15. So increase the liability with the interest expense. But if it was income, you reverse. You reduce the liability, you credit this. To recognize the interest, the net interest what? Expense. Imagine this is not accountant and refer fine. But here alimaliza na akakimbia. Unaona akiwa chini hapa hivi. Yale credit cash book na naona hiyo kitu iko sawa kabisa. Alivaa maji hizo vitu zote. Number 3, let's bring current service cost. Current service cost will increase your liability. So debit P&L with current service cost, then you credit pension liability. Pension liability ilikuwa ngapi? 600. Where are they hapo chini? To recognize current service cost for the period. To recognize the current service cost for the period. To recognize the current service cost for the period. That's well. That's what is asking for prayers. 2022, April 2022. April 2022, question 3B. April 2022, question 3B. April 2022, question 3B. Attended. Page 12. Page 12. Page 12. Page 12. Be hapo. What are they saying? The following accounting information was extracted from the Kimbo Limited regarding the defined fine. Net defined benefit obligation, 1st January 1850. Net defined benefit obligation, December 2000. Current service cost, contributions, benefits paid by trustees. The market yield on high quality corporate bonds is at what rate? 5%. Assume there are no tax implications regarding the retirement benefit scheme. With suitable calculations, explain the accounting treatment of the various elements of the defined benefits scheme on the financial statements of Kimbo Limited for the year ended this, in accordance with international accounting standards, that one. What are the elements? A, with suitable calculations, explain the accounting treatment of various elements of the defined benefit scheme. Which are the elements of the benefit scheme? We have interest components. We have interest component, another one, pre-measurement component, and current service cost component. So tufanye hivi, tuanze na suitable calculations, then we explain. Sure. So right there, actuarial gain stock loss on plan obligation. In purely obligation, there is no asset here. This is pure obligation. So actuarial gain stock loss on plan what? Obligation. This is obligation, hakuna asset hapa. The only thing touching asset is contribution, but the rest are obligations. So net defined benefit obligation. So present value of plan obligation brought down. Brought down was how much? 1850.
Yes.
January. Then, where is interest? Interest charge or interest expense, 5%. So give me 5% of 1850. You get? 92.5. Then current service cost. Current service cost. Current service cost we have 200. Benefits paid. Benefits paid. Benefits paid is 100 and what? 50. Subtract. Actuarial assumption. Actuarial assumption, how much? Actuarial assumption. Huh? 0.5. Actuarial, whatever. We don't know. So present value of plan obligation. Carried down. Carried down umetumia ngapi? 2,000. Gain loss. Gain loss is an obligation. That's a loss. Eh? Yes, that's a loss of how much? 7.5. Okay. Wow. So actuarial loss. So hiyo ni suitable calculation. Sijui hiyo sasa inaweza toa marks ngapi hapo. But that one cannot be 6 marks. Eh? Eh? Ati mbili. Umesema with suitable calculations explain the accounting treatment of the various elements of the defined scheme. So they're asking those components. So let's start with number 1 down there. Interest component. So there we have the elements here. We have interest. So we don't know interest. Yes. We have the interest component. Interest component. You say is the charge or change. Is the change in net pension liability? Is the change in the net pension liability due to passage of time? Due to passage of time. Full stop. Continuation. It should be charged. It should be charged or credited. It should be charged or credited to profit stroke loss. It should be charged or credited to P&L as finance cost stroke income. So one of the elements gone. So the elements in your natural nayo brought down and carried down. Eh? So this is called interest cost component. Then let's go to this one here. This is called current service current cost component or service cost component. Service cost component. Service cost component instead of a lot of stories. Service cost component. You say it comprises of the current service costs, comma, past service costs, and gains stroke losses. Online leo mmejaribu, hakuna watu wanatoka class. Gains stroke losses on curtailments and settlements. Basi hapo kwa curtailments you tuna draw line, eh? Not cartel. Curtailments. Curtailments is C U. Gains and losses on curtailments. Curtailments is C U R T A I L M E N T. Ndio?
Yes.
S inatoka wapi? Oh, curtailments and settlements. Curtailments dile unapunguza the number of employees, settlement kama umelipwa. But mistake hiyo ni story mingi. What I want you to know, current service cost, they take into consideration the current service cost and the past service what? Cost. Then down there, it should be charged to P&L. It should be charged to P&L. It should be charged to P&L as an administrative expense. should be charged to P&L as an administrative expense. As administrative expense, in bracket, staff costs. Staff costs. Correct. Haya, so hiyo tumechapa. Hiyo benefits wacha ingoje. Wacha tukuja hapa kwa actuarial loss, Actuarial loss again are called remeasurement. So andika hapo remeasurement component. Remeasurement component. Remeasurement component. Remeasurement component, you say, so kwanza niweke in bracket actuarial gain stock loss. So mkiwa na group discussion unauliza mtu what is your remeasurement component, watu wakingangana mambo ya actuarial gains, unasema remeasurement component, you say this should be charged or credited to other comprehensive income. This should be charged or credited to OCI, kama utaki story nyingi, to other comprehensive income for the period. For the period. Hivyo, hakuna story mingi. So those are the elements, but I can do an extension. We can do an extension of this. Benefits paid. Na pia kulikuwa na contribution mahali, sio? Yes, so we can do an extension, but ideally those are the elements. So do write for me there, benefits paid. Benefits paid. Benefits paid. Then you say, are amounts paid out of the plan assets. An amount paid out to the plan assets to the retired employees. To the retired employees during the period. Retired employees during the period. Mesikia kuna law imekuja mpya which will allow civil servants to even to retire at the age of 48. That can be better, isn't it? Asa. Lakini 48 ni mapema. Yes. But 48 is still young. Because 48 ada watoto wamemaliza kusoma. Sasa wewe. Right there, contributions to the plan. Contributions to the plan. You are confused. Contributions to the plan. The only another thing we want to discuss. Are cash flows paid into the pension plan? Are cash flows paid? Are cash flows paid into the pension plan? Into the pension plan, and has no impact on the profit stock loss. Has no impact on the profit stock loss, nor other comprehensive income. Has no impact on the P&L, nor other comprehensive income. Nor other comprehensive income. Full stop. Bas. Bado. Subtopic there, but tunamaliza. Hii kitu sijui. The last time it was examined, there's something I want to teach you, but there are two things nataka tufanye. Hii ingine tangu examine was 208 na ingine ni 206. Naziona ikitoka kwa syllabus. So tunaifanyanga for fun, but the ones they examine are the ones we have done. So we are safe. So niandikie hapo corridor limits. Corridor. So tupatane kwa corridor. Corridor limits. Corridor limits. Take 5 minutes break, then we come back for that.
Najari da zai da ban shi da ba da zai suke ban kwanci da da na stress suke da kuma daga zanga sai signori ora sai ne na skit fight stanno da devi guardare sai devi sa va Ele vai precisar dele, né? Você é muito boa, gama, você que vai dançar nessa outra vez. Então ele é não sei o uso. As novas estão bem até da casa. Não, fusão. Não precisa de ficar. shut up.
Unamaliza class ngapi?
Kuna kufuza hii. This is chicken, but this is the car. Yeah, go.
Class, we are back. CSR governor. Governor. So corridor limits. Wacha tuseme kitu before to answer. Corridor limits, what happens, here, what we have been doing. Any actuarial gain loss, we take to other comprehensive income in full. But there's a situation whereby we agree that any gain or loss within the normal contribution should not be credited to other comprehensive. The only amount we recognize in other comprehensive is again arising from the excess contribution. So whatever is within the space we capitalize, we add as part of your normal contribution. So it punguzie contribution. So right there I'm saying it is a materiality. It is a materiality approach. Oh, by the way, did you get the recording for the webinar on the practical what we are using? Yes, what they said there. Ilikuwa hii wiki. Mulipata? I think I have the whole video. But after exams. So never shares. But after exams.
No,
So it is important to know right now. Unaweza pata imesemekana kama umefanya hii wewe usifanye actuarials kwa mtihani. I'm going to share after class. Then you can also share. So, you share to help others. Wanajuaje wana CPA? It is a materiality approach that requires disclosure of pension gains and losses. Pension gains and losses. If such gains stroke losses exceeds the set limits. Exceeds the set limits. Exceeds the set limit. Full stop. Full stop. The amount to be recognized in profits. The amount to be recognized in profits should be that amount. Should be that amount in excess of the corridor limits. In excess of the corridor limits. In excess of the corridor limit. Full stop. Another hyphen. Corridor limit is the greater. Corridor limit is the greater. Corridor limit is the greater of the present value. Is the greater of the present value. Corridor limit is the greater of the present value of pension obligations. Of pension obligations. Of pension obligations. Or 10%. Huyu aliandikia vibaya. Inafaa iende hivi. Corridor limit is the greater of the 10% present value. Of the 10%, there should be 10%. Corridor limit is the greater of the 10% present value of pension obligations, or 10% of the fair value, 10% of the fair value, 10% of the fair value of plan assets at the beginning. 10% of the fair value of plan assets at the beginning of each financial period. Beginning of each financial period. Financial period. Full stop. Full stop. So down there, from what we have said, corridor limits, but I must put a disclaimer. You give me on our day set from I think but just to be safe. So we are just doing one question when we are done. Corridor limits. So therefore, corridor limits is equals to 10% fair value of plan assets brought down, or 10% present value of plan obligations brought down, whichever is what? Higher. That is the corridor limit. So any gain within the space, that one like for P&L, what you take to P&L is the excess. Is the excess amount. Is the excess amount. Down there you say the excess amount. The excess amount should be spread over the remaining service life. The excess amount should be spread. The excess amount should be spread over the remaining service life of the employees. Remaining service life of the employees in the scheme. In the scheme. Full stop. Another hyphen. If the amount falls within or below the corridor limits, if the amount falls within, or below the corridor limits, then no amount of actuarial gain stroke loss no amount of actuarial gain stroke loss should be recognized in the P&L. Should be recognized in the P&L. Full stop. Hizo vitu hata nikisema aje, without an illustration, it might bring problems. No amount should be recognized in P&L. There is a handout I've shared with you in the group. No, necessary. So, go to the group. The machine has refused. Go to the group I've shared. Online, I've shared with you on the screen. I've shared with you on the screen. So in that handout, you will do for me question 1 for your own practice. Do question 1 for your own practice. That one is the same with what we have been doing. Then I want us to do question 2 right now. Then question 3. Question 3, I'm giving you the solutions right now after class. Question 4, do for your own practice. So tumegawana. So my interest in this question 2. So let's read question 2. Let us read question 2. It says, the following information relates to K retirement benefit scheme, a defined benefit plan for the period ended 2008, 2009, and 2010. So we have discount rate. Discount rate is the interest rate, expected rate of return on plan assets, current service costs, benefits paid, contributions to the scheme, 9 million, present value of the plan obligations on 31st December, average remaining service life of employees, fair value of plan assets on 31st December. Additional information, as at 1st January 2008, the present value of the plan obligation and fair value of plan assets were both 1,000 million. Number 2, so number 2 is what makes the whole difference in that question. Net cumulative and recognized actuarial gains were shillings how much? 140. So the question is, why are they having actuarial gains which have not been recognized? They did not recognize because they were operating within the corridor what? Limit. So in the question, in case they have to bring this, they will not mention that corridor limit straight. But provided you have seen they have net and recognized gains, it means they are observing the corridor approach. Assume that all transactions occurred fine. Required actuarial gain or loss on fair value of the plan asset. Hiyo ni hii yetu ya kawaida tu. Then actuarial gain or loss on present value of plan obligation, hiyo kawaida. Net pension cost. So before you go to net pension cost, now there is adjustment we do because of that corridor. Then the scheme balances. So this is the last question we are working on. Now, they tend to be wide, so give me the answers as and if you have them. So write for me there, actuarial gain or loss on plan assets. So leo tumeambiwa tuanze na assets. So 1, actuarial gain stroke loss on plan assets. How many years are there? 3. So 2008, 2009, 2010. 2008, 2009, 2010. Shillings are in what? We don't know. Kuna millions mahali, ndio? Yes, ikuwa hivyo. This is a serious company. So we start with the fair value of plan assets brought down. So fair value of plan assets brought down. How much in 208? Both were standing at anataka kuidevelopia strategy ingine hapo mzuri. What was the balance brought down? Not one. So 1,000. Are you seeing the 1,000? Yes. Can you go to carried down 208? Itakuwa opening ya 209. Where are the carried downs? Huko chini, hapo chini before additional information. 10. 1092. That will be the opening in 2009. 1092. Closing 209, which rolls to 2010? 11. You know, closing this year becomes the opening. Then expected return. Expected return percentages 12, 11.1, 10.3. So chapa hiyo 12 of this, 11 of this, 10 of that. How much? Ania kona hizo figures? 120, 121, huh? You 121.21. But it work at 2 decimal places. So 121.21. The other side? 114.23. Sawa. Bring contributions. Contributions. Where are they? Contributions. 90, 100, 110. 90, 100, 110. Benefits paid. Benefits paid. Benefits paid. 150, 180. 150, 180, 190. Yes. So actuarial assumption. Now we are saving time. So tufanye hivi. Watu wa day. No, alimoni ndio inaanzanga, class inaanzanga na alimoni. Watu wa alimoni munipe 208, watu wa day munipe 209, watu wa evening munipatie 2010. So actuarial assumption. Watu wa alimoni 208 comes to 10 1060. Watu wa day 209. 209 comes to how much? Copy. 1133.21. Evening 2010 comes to 1140. 23. Actuarial balancing figure will be actuarial gain or actuarial loss. Actuarial gain or actuarial loss. So it means we check the closing balance carried down. So fair value carried down. How are the closing balances? Closing balances, where are they? Fair value December 1092. 1109. 10. 93. So tell me whether we gained or we lost in each case, and by how much. 209, we lost, we gained. This is an asset. We gained. We gained how much? 32. 209, 1133, 1109. Mepungua.
Yes.
A loss. A loss of how much? 24.21. 2010, 1110. Loss. How much? Loss of how much? 50.23. 3 marks. How do you get the 3 marks? How it is marked? Those are what are supposed to be marked. Yes. Are you on your click? Let's go to Roman 2 of the required. Roman 2, actuarial gain or loss on present value of obligations. So, tell the obligation to fund this time. Yes, imesonga mbio. So, Roman 2. Actuarial gain stroke loss on plan obligation. The 3 years. So present value brought down. Both were standing at 1,000. So go there, check the carried down. Carried down for 208 becomes the brought down 209. Mimi sijawasea au online. Naona mnasumbuka ati sioni board. Hii question you double. Hiyo sasa ni mambo ya technology. Sasa hapo siko. Naona Mary amekwambia double touch where I am. Yes, where the mwalimu is you double touch. It's simple. When the screen has been shared, hapana password. When you want the screen, the sharing, you double touch on the share. When you want the board, you double tap the board. As simple as that. Hakuna kitu complicated hapo. Well, then, yes, inaenda hivyo. If you want the question, double touch. If you want the board, double touch. Hivyo tu. Hiyo ni serious technology. Haya. So, why I must share? I don't have the question, so I'm using the screen share. So where is the present value of plan obligation? 1141. Roll here 1141. Then 1197. Kwa nini naona mmenyamaza? Si ndio hiyo? Haya, interest what rate? 1098. 10 of this, 100. 9 of that, 69. 8 of that, 90.
95.76.
76. Have those ones? Then bring current service costs. Current service costs. Current service costs, how much? Where are they? 130? Eh? 130?
To 2150.
To 2150. Benefits paid. What were they mwanza kujipanga na the first early morning, the first day, evening. Benefits paid 150, 180, 190. Wewe kwani unaongea kama K24 mbele ya TV. So actuarial assumption. Actuarial assumption. What were early morning? 1080. 1080. What were they? 1283.69. What were evening? 76. Actuarial gain loss. Then you get present value carried down. So get the closing figures. So carry down 28. 28 ni ngapi? 11. 1141. 209. 2010. 95. So assess to tell me gain loss for each. Yeah, it is that strategy of thinking. The first one is a loss, huh? Yeah, you increase. So how much? 61. The second one? 12, 11. Again. Sure.
Yes, again, 86.69.
86.6. 9. And finally, 25. Loss in another two. How much? Huh? 3 marks. Bus. Let's get the net. Let's get the net. Let's get the net. We shall be done kama ni mingi in the next 10 minutes at that rate. Net actuarial gain stock loss. So net actuarial gain stock loss. (2010). So on plan asset, plan asset ndio ilianza. Then on plan obligation. So plan asset, we gained how much? 32. We lost 24.21. We lost 50.23. On obligations, we gained 61. We gained 86.69. We lost 42.24. What? 93. Yes. Punguza hizo. Ilikuwa loss. Oh, these are loss. Sawa. It's a loss. So how much? The first one is 31. Loss, eh? Loss of 31. And this one remains again of 60. Then this one is a big loss. 47. So unajua ingekuwa hii nyingine ya kawaida, those are what we take to other comprehensive straight. But these people are observing the corridor limits. How do I know? They have net cumulative and recognized what? Gains. Atukuna? Which one? The first one. Sawa. The first one is 29. Problem is not the person who gave it. The problem is the person copying. Na wewe umeswitch off. Umekaa kama our pilots wamekuwa hired the other day. Kiasikia walienda wamekaa tu kwa cold room. Wanaambiwa waendesha, wanasema I used to, tulikuwa tunaziendeshanga 1995. So they are back. So if there was no note 2, check additional information number 2. That is what has brought chaos now. Net cumulative and recognized actuarial gains. That one means you don't recognize all of them. You only recognize what is overlapping. Now, what happens? You must determine, before you decide to take this to other comprehensive, determine the corridor limits. So, hapo chini, andika corridor limits. We have to get the corridor limit. So please, tafadhali, aki mkwesi stand by hapo. Nafanyanga hiyo kitu, then next week, watu wanaanza kukuja. I did not understand. How did you get the corridor? So from the corridor is the game changer. So make sure unaielewa proper. The next 3 steps, make sure you are standby. Thomas, and you have become serious of late. And what is the motivation? Ama kuna CS job mahali. 209 is okay. Now, so write for me there, corridor limits. The limit of contribution is a materiality test, 208, 2009, 2010. That is where now people start drawing lines. So how do you get the corridor limits? Take 10% fair value of plan assets. Plan assets brought down 10% fair present value of plan assets brought down. We will pick whichever is higher. We are going to pick whichever is higher for each year. Whichever is higher for each year. What was the plan assets brought down for each year? Many assets zote. Lakini ukiona present value. Sawa. Problem is the copy, not the writer. So check brought down. So brought down for plan asset was 1,000. 10% of 1,000 is how much? 100. 209, what was brought down in 209 for assets? 1092. So it will be 109.2. Brought down 2010 for assets. 1109 will be 110.9. 110.9. Obligations I have them here. 208, 1,000. 1,000 will give you 100. 1141 will give you 114.1. 1197 will give you 119.7. So the limit which you should not exceed is whichever is higher. So in year one, there is a tie. So means 100 is the limit. If there's a tie, then the tie is the limit. Whichever is higher here is which one? 114.1. Then this one is 0.7. Those are the corridor limits. Have that. Now, from the corridor is when we are going to know what goes to P&L. And what goes to P&L should be the excess. So right there, actuarial gains to P&L. So we are not transferring everything which we have gotten there. So you write here actuarial gains. Actually, let's be honest. See P&L, actuarial gains to other comprehensive. Actuarial gains to other comprehensive income. So what you will transfer will be based on the corridor. What you will transfer should be based on the corridor. So have 208, 209, have 2010. Have that. What was unrecognized at the beginning? So you start with unrecognized. Unrecognized gains. Yakoga brought down. What was the unrecognized gains at the start of the year? You have to pay in 208. What will be somewhere there? What took 140. Then the corridor dictates this year. So corridor limit is how much? 100. So the gain up to 100 should just be capitalized as part of the normal contribution. So what you need to take to the P&L is the excess. So the excess in this case, excess is how much? 40. So this 40, you don't recognize it in full. You spread for the remaining life of the employee in the scheme. So to P&L, divide by remaining service life was divide by service life. No, fanya hivi, divide by service life. How many years? Uko nayo hapo? How many years were remaining? You have them there. I see people text 10 years. Yes, it is 10. Ziko swali. Average remaining service life of employees in the scheme. Have you seen 10? Yes, 10 years. Actually, 10, 10, 10, 10, all of them. So divide by 10 years. So divide by 10. So 40 divided by 10 is how much? 4. So 4 is what you will take to P&L, imagine. That is what goes to P&L. Haya. Then you step ukielewa uko sawa. Then I need to know unrecognized gains in 209. To get unrecognized gain in 209, you must reconcile 208. You put a balance carried down and recognized, yield 209. So to that effect, hapo chini, andika unrecognized. Net cumulative, call it net cumulative, unrecognized gains. Net cumulative unrecognized gains. 208, 209, 2010. So these 3 steps, ukielewa sawa. We have no problem with you at all. That is at the bank max. What was the balance brought down? The unrecognized in 208 was 100 and what? So 140. The net unrecognized gains 208 brought down was 140. Then during this year, check the net actuarial for online here. The net actuarial for the year was negative what? 29. So you top up to that 140. So you come here and say, for the year, there was a loss of 29. Then to P&L, we have transferred out of 140, we have transferred how much to P&L? 4. Only 4 will go to P&L. Meaning the balance carried down in 208 will be how much? 107. 107. So this is the unrecognized gains at the end of 208. We started with 140. During this year, we lost. Net actuarial loss was 29. Then of the 140, what has been transferred to the profit account is how much? Which is OCI? 4. So remaining is 107. So bring here 107. 107. Then Panda Jupia. 10 what? 7. 107. What is the corridor limit for 209? 114.1. So the unrecognized gains, the unrecognized is 107. But the corridor you are allowed to contribute up to 114. Anything within up to 114, you are not supposed to do what? To recognize as gains. Therefore, excess is what? Nil. There is no excess. Hakuna excess. So there is nothing to go to P&L. It is within the corridor. So, yes, so there is nothing. Teremuka chini, you reconcile the net, you got it brought down for 2010. So for the year, we check for the year. For the year, we gained how much? 62.48. To profit account, which is OCI, we have transferred nothing. There is nothing we have transferred. So how much is the balance carried down? 169.48. 169.48. 169.48. Corridor,
90.7.
Give me the excess. Give me the excess. And from there, 5 minutes.
9.78.
40?
9.78.
0.78. Divide by 10.
4.97.
So 98. Can you say 98? Yes. Haya. Teremka umalize hii. Teremka hapo chini. For the year we lost how much? 90. To P&L. Carry down. So hii sipitishe 24 hours kama ujarevisit hapa. Unaweza shika saa hii lakini hapa 24 hours umepotea tena kanganikiwe. How much is remaining? $72 point. Video. Thank you. Asana mbele kabla tumekuwa bora. Rahisi. Ukifuata venye naenda haina maneno. To get brought down you must do this one. So what did they want again? Net pension cost to be charged to income statement. So right there, net pension costs. Net pension costs. Lakini hata ukiachana hii hata hakuna difference kubwa kwa marks. 208, 209, 2010. Pension cost, you will bring for me current service cost, interest charge, what else do you want to bring? You bring those ones first. What was the current service costs? Simunisomea alafu niweke mpaka mwisho. 130 to 20 150. Interest charge hapo kwa obligations mko nazo 100 1.69 95.76 you less expected return. Expected return is an income. How much was the expected returns on the plan assets? It was the first one. 120.
1.21. 114.23.
114 point? Okay. I get this. So those ones, did you require the corridor? Up to there? It doesn't, no. Those ones have nothing to do with the corridor. How much? Huh?
110.
201.48. 131 point? 58. Other comprehensive income, actuarial gains. So now, hapo tu ndio utapata wrong peke yake kama ukufanya corridor. If you don't do the corridor, you will get it wrong there. So check where we wrote actuarial gains to other comprehensive. So year 1, we transferred how much to that account? 4. But now 4 is an income. Remember, these are expenses. So utilize the 4 to reduce the expense. We transferred the 0. Then we transferred 4.98. So utilize this to reduce the expense. Kwisha. Hiyo imeisha hivyo. Here middle ni 201.48. That is the net pension cost. Net pension cost 106. Na mwisho ni eh? 1.55. So how many marks were they allocated? 3. How you 3? You 3 another part. How many another part? Whichever. Let's do the balance sheet, then we are done. Balances. Scheme balance to reflect in the balance sheet. Yes. So balances to SFP. Na mkifikiria mmechoka, watu wa morning wako na class at 11 in the next 10 minutes. Morning si ukweli? Ukimaliza hii kitu na umepita yote, uandike kitabu. My life in CPA. Not bazaar, CPA. All my personal life. There come a composition. Ile ulikuwa na zanga na I clearly remember. It was in the year 2022. So fair value, no, what is the present value? Present value of plan obligation. Hebu nipatie hizo closing figures. Closing. You pick the closing figures. Pick the closing figures. Yeah? The closing for plan obligation 1141, 1141, 1197. 1141, 1197, then 1295. What about assets? 10. Punguza. Hii asset ipunguze obligation. 11.0. Pia ipunguze obligation. Then 10.93. Hii pia ipunguze obligation. Now, what many people will forget. Unaona hiyo kitu inaitwa net unrecognized gains. You know that is an asset. Unrecognized gains, in gains receivable. Are you aware of that? Ukiwa na in your books you have unrecognized gains. What is that? An asset to the company. So you bring it here. Unrecognized gains, but carried down. Pick the closing figures. 107. So are you 107? Punguza is an asset. 169. Okay, now the net position will remain an asset. Then 72.03. Where did you put that up? I think it's net pension asset. Net pension asset. Net pension asset. Correct. Because of time, those totals you can do even at home. Nobody will mark even those totals. We will revise here. Now, niandikia hapo chini, but this one is something easy which you can do at your free time. Over stroke under. Andika hiyo. Over stroke under funded schemes. Write that subtopic. Over stroke under funded schemes. Na watumia hizo notes ni kitu mnaweza soma muelewe. Then you apply that under stroke over in illustration 3. Whatever I'm giving you, I know something you can manage. That question 3, both 3A and 3B. So I'm sending you the solution. Just check on it keenly. Make it manageable. So I'm sending in the next 5 minutes. Plus those notes. You are under and over. Uandike, then uangalie question 3. Kifanya hivyo. So we are meeting tomorrow evening. I think all of us decide to go the same level in all classes. So new cash flow ya next. Kila mtu cash flow ya next. So jana ulikuwa class. Unasema yes. So we finished that cash flow. Then after cash flow, in the respective classes, we'll be doing EPS. Then next week when we meet, we are doing reconstruction. Reconstruction. So combined reconstruction, we are remaining with the 2 weekends. Yes, 2 weekends to go. So when you want to kusumbua siku hizi umepotea, waambie nipatie weekends, wewe weke 3 because of exam. Lakini for class, really. Thank you. So I'm sharing with you that webinar. Sure. Listen to it carefully. Ndio kama wewe uko exempted, unajua kila mtu anajijua. Unaweza pata uko exempted on something, you get to know. So I share, also share with others. Usikue nini can help. Nini ya jana? Recorded. Hizo nitatuma. Webinar na hii class tofauti.